This is Barry now from Ironsides Macroeconomics. It's Monday morning, February 12th at 8:30 a.m. Mountain Time. This is the free version of our weekly audio summary of our weekly note, of which you as a free subscriber received just the first part of the note. There's obviously far more details. These notes tend to run to about 3,000 words with 8 to 12 charts and tables in them. This week, we added some enhancements to our asset and sector allocation product. Again, that's available when you become if and when you become a full paid subscriber. So the note this week was titled "The Wrong Price." That's a reference to banks that own performing assets at the wrong price, accumulated primarily in 2021 during the pandemic. And we think a lot of the regulators, policymakers, and some market participants are misunderstanding what's going on in the banking system. They have something of recency bias. They're looking for big credit problems like we had in 2008, when in fact, the current situation is a lot more like it was in 1980. And in 1980, when Volcker created this deep inversion of the yield curve, even deeper than we have today, that in essence started a process that created or disintermediated the thrift industry, which provided 80% of mortgage credit at that time. The assets performed, but they were impossible for that thrift sector to be able to finance those, given problems with Reg Q. That whole deposit business was being disintermediated by the money market industry at that time, and it was in essence an existential business model threat to that thrift sector that never really recovered. They did have asset problems later on with assets they accumulated in the 80s, but at that time, 1980, there was nothing wrong with their assets. They just couldn't finance them. And that, in essence, is the problem, maybe not quite as acutely, but is the problem in the regional bank sector today. So moving on a little bit to broader markets, with the S&P having hit 5,000, the focus is all on Gen AI, but there's a couple of other very important themes. One is the manufacturing renaissance, modern supply side theory, industrial policy. We had very good results for the industrial sector away from the transportation portion of industrials. That theme looks very strong, and those stocks are performing well. We obviously have this curve inversion and what it means for the banking system. We had a lot of Treasury supply last week, and there was a serious price concession through Thursday's close, in order to absorb record amounts of 3-year notes, 10-year notes, and 30-year bonds. We backed up the Treasury curve anywhere from 23 to 28 basis points from 2s out to 30s. And a lot of that price concession in the back end came through real rates, which we think is maybe the starting point for a rethink about what the terminal rate is likely to be. The Fed has been steadfast that they're going to be able to lower the policy rate all the way to 2.5%. We're far less convinced. And so we got into that in our section on the natural rate as to what are the big drivers of that dynamic and where we think it's going to wind up. Spoiler alert, it's not 2.5%. We think probably more like 4%. We then really dug in on the bank sector to get to this point about what's really going on, and the fact that when the Fed decided to do the tightening process or remove accommodation the way they did with passive QT and aggressive rate hikes, once they went through 3%, they caused that deep curve inversion that just makes the operating environment very difficult for the banking system. We went through all the gory details: supplementary leverage ratio, ending of the exemption for cash and treasuries, which forced deposits away from big banks to smaller banks, was part of the whole Silicon Valley Bank story, allowed some of these other banks to grow rapidly, some of the regulatory changes that are making things difficult. And again, a paid subscriber, you can get in, see all the gory details on that. A couple of macro factors that were important last week. We heard a Fed official talk about sustained and broadening of the disinflationary process. We got good news on the Atlanta Fed wage tracker, which makes it look like the wage disinflation we saw in the employment cost index in the fourth quarter probably more telling than the quirky looking numbers we've gotten out of the average hourly earnings series the last couple of months, including January, because that Atlanta Fed wage tracker dropped sharply. We then dug in a little bit on the CPI revisions, which showed a little broader inflation story. Inflation is not quite, or disinflation is not quite as dependent on goods deflation as it had been after these revisions, but still a little bit lopsided. And so we need service sector disinflation to improve, housing to start to weaken a little bit. And we'll see. We get CPI tomorrow, so we could talk more about that next week. So that's it for me this week. Again, our asset allocation product is available, the full subscribers asset and sector allocation. We are remaining market weight in tech and related, overweight industrials, energy and materials, underweight banks and small caps. We don't think the healthy broadening out comes until the Fed starts a fairly aggressive rate cut cycle. And in order to get to that, we're going to need our 4.4s to start to materialize, meaning a 4% unemployment rate, wage growth below 4. That'll allow the Fed to cut to 4 and keep the 10-year note in the vicinity of 4. So that's it for me this week. Barry Neff from Ironsides. Please consider becoming a full paid subscriber. If you'd like a trial, let me know. I'm happy to give you one for a month or whatever time you need.